Hello, welcome back. In this video we are going to talk about a very important topic. If you are a new investor who is just getting started in the world of investing, this video can actually save you tons of money, if not millions, frankly. And it may sound weird, but I will explain exactly why that is the case. And so we're going to talk about mutual funds, index funds, and the proper way to invest in these. Now, if you have been watching my channel for a while, you know that I do like picking my own investments. I do like investing in single companies, but this comes with a lot of responsibility. You have to really know what you are doing, and you have to be willing to take some extra risk as well. And during this, I also like to be invested in a basket of companies, as we call index funds or mutual funds, because they give me a little bit of extra insurance, really, and it makes for some part of my investing that I don't need to be paying close attention to, so I can just leave it grow forever and just wait out to see what happens after, let's just say, 30 years. More or less, it's like an investment fund. But the thing is, how should we be investing if we're talking about index funds and mutual funds? And what are those really? What are the pitfalls that we can fall into and what we should be careful about? Now, in this video, I'm going to explain how you could potentially lose millions again or hundreds of thousands if you do it the wrong way. And I will show you exactly why with the numbers, really. And so I'm having Morningstar here, in which I'm having the S&P 500 ETF, the well-known VOO fund, which is open right here. This has a 4-star rating from Morningstar itself. And I have a few others as well, like the Artisan Global Opportunities one here, which is another 4-star one. Or over here, the Morgan Stanley International Advantage Fund here, MFAPX, another 4-star one. And last one, I have the Vanguard High Dividend Yield Index Admiral Fund. And actually I was invested in this one for a while in the past. But I will explain what is the difference between those and why it doesn't make sense at all to invest in some of these ones, what could be wrong about this. Now, if we take a look at the quotes here for the funds, you can kind of see some information which can seem a little bit daunting, because many people don't really know what a mutual fund is or what an index fund is. And practically speaking, you can think of a mutual fund as a basket of investments. And this could be anything. This could be a basket of some stocks, a basket of some bonds. It could be all sorts of things, even cash, really, frankly, pretty much being part of this fund. So it's almost like a collection. It is a collection of different investments. It could also be real estate, for example, or REITs, for instance. So if it is a collection of investments, who is actually picking this collection of investments for the fund? Now, there are index funds, which are sort of like more or less known as passive funds, passively managed funds, and there are actively managed funds. Now, passively managed funds, they are called passive because they are basically tracking indices or indexes, as you prefer, whichever you prefer to call them with. An index, for example, could be the S&P 500 index, the well-known Dow index, for example, or these are indexes that different funds could be tracking. And the way to track this is by basically buying the allocation that these funds have and pretty much mimic these. And so if we take a look at the Vanguard S&P 500 ETF here, this is exactly what it is doing. And you can kind of take a look at its portfolio here if we click on the portfolio page. And you will see that it is basically tracking the S&P 500 fund here. You will see the portfolio. It's an allocation of Apple, Microsoft, Amazon, Alphabet, Tesla, and so on and so forth. You can kind of see the exact allocations here, the weight. Not all of these have the same weight because it's the S&P 500 is a weighted index. And so the same thing happens with the index fund here. And so basically this will be tracking the S&P 500, and whenever there is a small change in the S&P 500 itself, this will change as well. But generally speaking, there will be no other change happening during the, let's just say, 20 or 30 years that you may be holding this fund. Now, there is a very important thing here. Take a look at this expense ratio. If you buy a fund, for instance, from Vanguard, for instance, which will be holding this one, you're going to be paying some money to Vanguard for the privilege of holding that fund for you. And this ratio over here, this expense ratio, is how much you're going to be paying to Vanguard, pretty much. And so for this one, it's going to be 0.03%. That is a year, and that is of your total holdings. So if you are holding, let's just say $10,000 with Vanguard, you're going to be paying $30 a year, pretty much, for the privilege, again, of holding this investment through your Vanguard account. And so that is fair. 0.03% is just fair. But let's take a look at another one over here, for instance, the Artisan Global Opportunities one, which is another fund. And this one, if you will see here that it has an expense ratio of 1.14%. This is almost 1.1%. It's actually more than 1.1% more in terms of the expense compared to VOO here. And this fund is basically an actively managed fund. It's a global large stock growth fund, as you will see here. And you can kind of see what it has been doing in the past. And also, again, we can take a look at the portfolio here and see exactly what the fund is holding. And in this case, with the Artisan Global Opportunities Fund, you will see that it is holding these kinds of investments here. It's Viva Systems. This is a well-known US company. AMD over here, Next Era, UBS, Alphabet. It's basically an allocation that is an active allocation, and it's happening by some managers that are getting paid to pretty much construct a portfolio for you. And so whenever you buy this portfolio, you're going to be paying some money back to them, or the company who is actually holding this for you. And that will be in the amount of about 1.1%, 1.14%, as we examined earlier. Now the thing is, if you examine the yield, the growth basically that this fund had, and compare it to VOO, which was much cheaper, remember, you will see here, and again we can take a look at the growth of $10,000. You will see that VOO would have increased to $40,000, and ART would have been 36.3. So in the meantime, even though you have been paying an extra and a lucrative extra really of 1%, 1.1%, you have gained less. And I can even look at other investments of that sort, like the Morgan Stanley International one, which has a 1.26% expense ratio. And in this one, you would have made way less, 28.8 is what you would have made over here. So you would have actually lost a lot if you have invested in this one compared to VOO. And in the meantime, you would have been paying for this one, which frankly is one of the reasons why you would have lost quite some. And let's just take a look at another one, the Vanguard High Dividend Yield, which is one that I kind of liked, although it's not better than VOO as well. You will see here that it's $34,000. The only more interesting thing about a high dividend yield one would be the fact that it could do well during a recessionary period potentially. You can kind of see here, for instance, the year to date for this fund has been minus 3.7%. If you take a look at VOO, the year to date has been minus 12. The Artisan one has been minus 24 here, and the the Morgan Stanley one has been minus 29%. Because these kinds of funds more than likely try to take advantage of the current situation, in the previous situation in the markets where everything was going higher, and so they had a collection of stocks and companies that were growing. But when we're entering a sort of like a recessionary or lower growth period, then these tend to do worse, and this is why you're looking at this kind of destruction really in terms of what they're doing right now in this current yield. But again, even through all of these other three funds here, VOO was the clear winner. And despite the market conditions, this will more than likely remain the winner for the upcoming years. If you're taking many years into account, it's probably going to be an about 10% yield a year is the average that this has been doing through about 100 years of time, really. It's moving along with the rest of the market. It's the S&P 500 pretty much. And this is the benchmark. This is why it's the benchmark, and every other investment is trying to beat this one. And so the thing that I wanted to really point out here is to be super cautious about the expense ratio, and it may not look that much. Again, this is 0.03 here, which is fine, but this one was 1.1. Remember when we took a look at this, 1.14, and the other one over here was like 1.26, and this is like 1% to 1.1% more than the VOO one. And it may not sound that much. You may be like, okay, it's just 1%, what's the big deal? And I will show you exactly what the big deal is, and the deal is huge because you can lose tons of money. I have opened up here my investors haven, basically our tool here, the tool that I'm using for everything I do here in my channel. And I have a little tool here which is called the compound interest calculator, and it's gonna calculate for us how much money we're gonna be making in 30 years time if we have invested, let's just say, in VOO here. And so VOO, let's just say it does 10% a year. We already know that it does about 10% a year. This is the S&P 500, but we're going to go as if every other investment, all of these are basically making 10% a year, which they are not. But I'm going to suppose that for the sake of the argument here. And I'm going back to my tool over here, and I'm going to start by saying that I'm willing to invest today, let's just say $100,000. So I'm investing $100,000 today, and that's all I'm going to be investing forever in the market. Now, I'm not going to be having any monthly contributions here. It's going to be zero, and I'm going to leave the money in the market to grow for, like, let's just say 30 years here. Now, the interest rate is basically how much we're going to be gaining a year, right? So it's going to be 10%. Basically is what we're getting out of VOO, for example, 10%, which was the 0.003 in terms of the loss, basically, that we're getting. So it's practically negligible. It's going to be about 10%. Actually, it's going to be 997. But okay, let's just say 10 to make it easier to calculate. So we'll calculate here, and you will see that during this scenario, in year 30, we're making $1.74 million. Now, let's just say that we invested in this one, in Artisan Global Opportunities, and actually this made us 10% a year, but now we had to pay the expense ratio as well every year, and that is every year, remember. So this is 1.14, and I will actually make it 9%, which is actually more than what it makes, because this should be 8.9, for example, but again, just for the sake of the argument, let's just make it 9%. And remember, we had the 1.7 for the previous one. So now with the 9% interest rate, which is our gains pretty much, we're going down to 1.32. So we actually lost about $400,000 in 30 years just because we're paying this extra expense here. And remember, we're more than likely not even going to be making as much because the growth hasn't been the same as it has been with a much simpler and cheaper index fund, which VOO is. We haven't made as much as you'll see here, so we would have lost even more on top of what you are seeing over here. And if we go with an even higher interest rate, which this one was, for example, it was 1.26. So let's say in this case, let's just go with 8.8, which is what it is. And in this case, we're actually going down to 1.25. So we lost almost another $100,000 just from paying this one. And so you can understand how important it is to avoid paying these expense fees, which make no reason, frankly. And now you can also understand why it's a very bad idea to be using some web applications and some sort of like management in terms of your economic assets, some financial assets and managers, really, that there are many of those around that are actually typically trying to invest for you. Some robo-advisors and all that stuff, and they get some money, some fees out of your investments every year, just as an expense ratio. It could be 0.5%, 1%, 1.5% even, or even more in some situations. Now you can see that you are leaving tons of money on the table just by using this, and you really don't have a need to. If you really want to invest in a fund of this sort, like the Artisan Global Opportunities, you can even, practically speaking, avoid the expense ratio and just create it on your own. The thing that you would need to do is just go in the portfolio page here, and if you really believe in this kind of investment, which you probably shouldn't really, you can basically recreate this in your own way, just by buying 5% of your portfolio, 5% of your portfolio value, but just by buying Viva systems with this. So, for example, if you were willing to invest $100,000 total, 5% of that would be 5.2% would be $5,200 invested in Viva, $5,180 invested in AMD, and so on. This is frankly what you should be doing, and you can basically mimic this fund without ever paying the fee. And this is exactly what you're doing here. So yeah, why would you pay hundreds of thousands of dollars just for that? So yeah, this is what I wanted to talk about in this video. This can really save you tons of money if you stayed and watched till the end. And if it did help you, please leave a like and subscribe, and let me know what you're thinking about these kinds of mutual funds, index funds, and whether you are invested in any of those or you are just following the S&P 500, maybe an international total market or something of that sort. But thanks for watching again, and I'll see you soon, guys. Bye bye.